Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello students. Hello. Today I want us to study about bank reconciliation statement. I want us to study about bank reconciliation statements. Bank reconciliation statement. And what is a bank reconciliation statement? What is a bank reconciliation statement? A bank reconciliation statement is a statement that explains the difference between the bank balance and our cash book balance. It is a statement that explains the difference between our bank balance and our cash book balance. And this statement is prepared on a monthly basis. It is prepared on a monthly basis to find out why there is a difference, because actually it is usually happening between the bank statement and the bank statement balance and the cash book balance. We prepare a statement that explains why there is a difference between the two statements. Now we know that there are three types of bank accounts. There are three types of bank accounts. There are three types of there are three main types of bank accounts. There are three main types of bank accounts. Number one, we have a savings account. We have a savings account. We have a fixed deposit account, and we have a current account. In the banks have three main types of accounts. Savings is where you save money on a regular basis, hoping to do something with it. And a fixed deposit is money you put in the bank to either earn you interest as you plan on how to use it, or as you plan how to withdraw it. Then we have a current account. This is an account whereby you are given a checkbook. This is the account where you are given a checkbook and you write checks in the office. Instead of going to withdraw money and you are paying people directly, you give them a check, they take to your bank, and the money is taken. Now, this account is the one that has a difference. The balances here and here will only change most probably because of the interest that we have earned. But now this account, because of the number of transactions that we have to prepare a statement called the bank reconciliation statement. Now, it is important to understand the way we prepare cash book and the way the banks prepare the bank statement, so that you can be able to know how to prepare the bank reconciliation statement. We know that in the farm, the business books, in the business books of accounts, we have a cash book. We prepare a cash book which has 2 or 3 columns. Talk about 2-column cash book and a 3-column cash book. Let's focus on the 2-column cash book, where we have cash and we have bank. We have cash and we have what? Bank. Where we record all the money that comes to the business. If it is cash, we debit the cash account. If it is bank, we debit bank account. When we are paying, we credit cash if you are paying in cash, or we debit bank when you are paying in bank. Now, the account that we are reconciling with the bank statement is this account. It is the bank column. We forget about the cash column. And the area we concentrate on is comparing our records with the records of the bank, with the records of the bank. So we focus on the bank column of the cash book. We focus on the bank column of the cash book, and we know that when money comes in, we debit the bank account. When we take money to our bank account, we debit our bank column. We debit our bank column. When we pay somebody and we give a check, we credit our bank column. We come here and we credit our bank column with the payment. We credit the bank column with the payments, and with the receipts, with the monies that we are receiving, we debit. The money we are receiving, we debit, and the money we are paying, we credit. Now, when it comes to the bank, the bank will give you something called bank statement. The bank will give you something called bank statement, and it is as at specific date, say 30th of June 2025, at the end of the year. Now, what does it have? The bank statement has date, it has particulars about the person you are paying or where you're receiving the money from, it has debits, and it has credit, and it also has balance. The debits and credits and balance. So that's the format of the bank statement. The bank statement, you have a column giving us the date, the particulars, the date, the debit, the column, and the balance. Now, please mark this. Now, this account is maintained from the bank's perspective. It is maintained from the bank's perspective. It is not by the business. So this is from the bank. So to the bank, the money from the business is a liability. The money from the business is a liability, and therefore, as you bring money into the bank, we always say an increase in a liability, we credit the liability account. So all the money that comes into the bank, we have deposited into the bank will be crediting. The bank will be debiting its own account to record an asset, an increase in asset in terms of money, and they will be crediting our account. They will be crediting our account to record a liability. Why are they recording a liability? Because one day they will pay us. And therefore they will credit our account as they debit the money they are receiving. Now, when we write a check and we are paying and we are crediting bank, now the bank, when they receive that check and they pay, when they are paying, they are reducing the liability. And therefore they will be debiting our account. When the bank pays money to our suppliers or to our employees or to whoever you want paid, they are reducing their liability. Which liability? The money we give them. When they pay, they are reducing our what? Liability. And therefore they debit our account. To the bank, we are a liability. When they receive our money, they record it as a liability by crediting it. And when they pay on our behalf, they are reducing their liability, so they will debit our account. And therefore it is worth noting. It is very, very important worth noting, because these are concepts that confuses very many students. Is a concept that confuses very many students, that when we receive money, we debit bank. But when we receive money and we take it to the bank, for us, we record an increase in money, we debit our account, but the bank will credit. As we receive, we are recording an asset by debiting the asset account, but for the bank, as it receives, it's a liability, so it will credit our account. So, if you want to check whether what we received was recorded in the bank, you will come and you record what we received, which is the debit side of the cash book, and you compare it with the credit side of the bank statement. Whatever we receive, it's our debit in the cash book, but in the bank statement, it's on the credit column. So if you want to check whether what we received and we recorded that we have taken to the bank is actually correctly recorded in the bank, we compare the debit side with the credit side. You compare the debit side with the credit side. You compare the debit side with the credit side. And these are very, very important. You're going to see a very important part of preparing bank reconciliation statement. If you want to check whether all we have paid on the credit side has been correctly captured by the bank, we will not come to the credit side of the bank, we will come to the debit side of the bank. We come to the debit side of the bank because as we pay, when the bank pays on our behalf, it is reducing our liability. It is reducing our liability. It is reducing our liability. Now, what you realize is that if you say cashbook, and I now focus only on the bank column, and then we say bank statement. Assume that we start a business by the owner bringing money into the bank, 10,000 shillings. 10,000 shillings. Now, we will record that in the cash book, the double entry that we make in the cash book, we will debit bank. We debit bank with 10,000 as we credit capital. Account with the 10,000. Debit bank with 10,000 and the credit capital with the 10,000. Here we say bank account and get 1st of January 25. And here 1st of January 25 we say capital. We took money. We started a business by taking 10,000 shillings into the bank. Now, in the bank statement, like we say, the bank will say date, particulars, debit, credit, balance. So, it will say on 1st of January 25, we received money from the investor amounting to 10,000, and the total liability the bank owes this customer is 10,000. The total liability the bank owes this customer is 10,000. Now, for instance, if we buy motor vehicle or if we buy a bicycle worth 2,000, we buy a bicycle worth 2,000. We buy the bicycle from Justus Kagodo. We buy the bicycle from Justus Kagodo on 5th of February 2025, and we are saying check number 20. We know we are giving it to Justus Kagodo for 3,000. Now, when Kagodo brings this check maybe to the bank on 6th, he bought it on. We gave the check to Kagodo on 5th. The following day, on 6th of January 2025, he comes and he cashes the check, Justus Kagodo, and withdraws the money. He withdraws. So the bank pays on our behalf. And as it pays on our behalf, the liability that it owes us reduces with 3,000. So 10,000 minus 3,000, the balance is 7,000. And you can see now the situation is on 6th of January 25, our balance carried down in our books is 7,000, and in the bank statement the balance is 7,000. Now, that is the ideal situation. That is what we should expect to be happening when we are transacting. But more often than not, you will find that the balance that the cash book is giving you is not the balance the bank statement is giving you. That tells you that there are things that were recorded in the cash book that are not in the bank statement, or they were recorded in the bank statement and they are not in the cash book. And those are the things we investigate. Those are the things we investigate with three objectives of preparing a bank statement. We prepare the bank reconciliation statement with three objectives. Number one, we want to update our cash book We want to update our cash book with everything that has been captured in our bank statement, but we have not captured it in the cash book. But it's not an error. Some of the things that were recorded correctly in the bank statement, but we have not collected in the cash book, and therefore we update our cash book. We update our cash book. We update our what?
Cash book.
Our cash book. Now, the other reason is to prevent and detect. We prepare bank statement. The first one to help us to update the cash book. The other one is to prevent and detect errors and fraud by the accountant. That's number 2. Prevent and detect errors and fraud made by the accountant. Because when you compare what the accountant has done and what the bank has done, if they don't agree, it could be because of an error by the accountant. It could be because the accountant has stolen some of the monies. So it helps us to prevent and detect 2 things: errors and fraud by the accountant in the firm, or prevent and detect errors and fraud committed by the bank. Errors and fraud committed by the bank. 3 very important objectives of preparing the bank statement. Number 1, we want to update the cash book with whatever is correctly captured in the bank statement, but it is not captured in the bank statement, in the cash book. We update our cash book. Number 2, to prevent and detect errors in the firm, in our business, which have been committed by the accountants. And number 3, to prevent and detect errors and fraud, which could have been committed by the bank statement. So we quickly study what is it that could be causing the difference between the cash book and the bank statement. Number 1, it is when items in the cash book. Items in the cash book not recorded in the bank statement. Items in the cash book not recorded in the bank statement. Number 1, items in the cash book not recorded in the bank statement. We talk about uncredited deposits. Uncredited deposits stroke checks. Uncredited deposits stroke checks. We are saying it is possible that we take money to the bank on the last day of the month. On the last day of the month, we take money to the bank and we record it in our cash book. We record it in our cash book that we have received that money. Assume we receive 100,000, and in our cash book, we are receiving the money from Peter Mogoroki. We receive 100,000 shillings from Peter Mogoroki. He brought us cash, and we took that money to the bank. But the bank, by the time it was closing the books, it did not credit our account. Remember, recording our money, they will record that we have received our money by crediting our account. So the bank fails to, at the end of that period, by the time the end of the last day, they have not credited. We have recorded that we have received the money. Our money has increased, but the bank has not increased our money. The bank increased our money the following day. If it was on 30th of June, we record on 30th of June, we received our money, 100,000, but the bank records it on 1st of July, the following day. So our balance, cash book, and the bank statement will not agree. This could be either cash, which we are calling deposits, or checks. Somebody gave us a check, and we recorded that our money has increased, but the bank has not increased. It is called uncredited deposit. It's called uncredited deposit. What we receive, we call it uncredited deposit. But again, there is something we call unpresented checks. Unpresented what? Checks. What are unpresented checks? When we want to make payments, we want to pay our customers, we write them checks. We don't go to the bank to withdraw about 50,000 shillings to give to a customer. We issue a check. Now, once you issue that check, that customer could go and stay with that check without taking it to the bank. For a day or two. Now, assume again, we give somebody a check on 30th of June. We give somebody a check we give just as Kagodo a check for 3,000 on that 30th of June. We gave Kagodo that 30th of June, we gave him a check of 3,000, and we showed in our cash book that we are paying just as Kagodo with 3,000. So we reduce our money in the cash book with 3,000, but just as Kagodo does not take the money until on 2nd of July. That's when our money will be reduced. But we were doing our accounts as at 30th of June. We are preparing our bank reconciliation as the 30th of June. But Kagodo takes it on 2nd of July. So by the time we are doing our reconciliation, the 3,000 has not been deducted by the bank. It is called unpresented checks. All the checks which have not been presented, they cause the difference between cash book and the bank statement The other possible causes is errors by the accountant or errors by the cashier. For instance, we deposited 100,000. And therefore we debited. We deposited 100,000, but instead of recording in our cash book 100,000, we recorded 1 million. But the bank will not record 1 million. The bank will record 100,000. We deposited 100,000, but erroneously we wrote 1 million shillings. And therefore the bank will capture 100,000 and you have added 1 million, so there will be a difference. It is called errors made in the cash book. Now, then the other possible reason for difference between the cash book balance and the bank statement, it is items appearing in the bank statement. We have already discussed items appearing in the cash book, but not in the bank statement. Number one, we have said is uncredited deposit, all checks, and unpresented checks, or errors, or even fraud. Maybe we received a million shillings. But we received a million but we took to the bank 900,000. There are receipts we have issued and they are showing we received a million shillings, but we took to the bank 900,000. It will be clear that we have lost 100,000. It will be clear. Now, there are items appearing in the bank statement that are not in the cash book. They're in the bank statement, but they are not in the cash book. For instance, when we transact business with the bank charges for their services, and there is something called bank charges. There is something called bank what?
Charges.
Bank charges. Maybe for every transaction, every time you go to the cashier and the cashier gives you maybe about 100,000, the cashier may charge 50 shillings for every transaction. The cashier may charge 50 shillings for every transaction, and therefore the cashier would debit our account with 50, but we do not know. We do not know how much they charged us. And therefore, we will not capture that 50. The next time they do something, they will cut 150. And then we do not know. We have not captured it. They are called bank charges. They appear in the bank statement, but they do not appear in the cash book. Maybe one of our customers is very far away. We supplied goods to the customer, and the customer decides to go to the next branch. We supply to our customer, and the customer knows our account details in the Equity Bank. We're in Nairobi and the customer is in Meru. The customer goes to our branch in Meru and deposits the payment into our bank account. The customer deposits the payment into our bank account without telling us. It is called direct deposits. It is called what? Direct deposits. It's called direct deposits. The customer deposits money into our account in Meru and does not tell us. So our money will balance in the bank statement will be more than the money balance will be showing in the cash book. We may also have something called dishonored checks. You may have something called what?
Dishonored
what?
Checks.
Something called dishonored. What are dishonored checks? There are checks which we received from our customers, and we say, from Peter Bogoroki, we received a check of 1 million shillings. We received a check of 1 million shillings, and we recorded in our cash book that we have put in our bank account 1 million shillings. We have put in our bank account 1 million shillings. And we brought the check here, and the bank, in the course of processing that check, we realize the customer does not have money. The customer does not have money. Or the names of the customer, the names written on the check disagree with our name. And the bank fails to accept. The bank which is supposed to pay our money fails to pay our money. And therefore that check is returned. We have recorded in our cash book that we have received 1 million shillings, but the bank has not recorded 1 million shillings. That will cause the difference. It is called dishonored checks. It's called what? Dishonored checks. We may also be receiving things like interest and dividends. Maybe we have bought debentures. We have given our money to some people, and they are giving us interest income. They are giving us what? They are giving us what?
Interest income.
They are giving us interest income. They are giving us interest income. Now, they said they put the money into our bank account. They put the money into our bank account, and therefore our money is increasing. Our money is increasing, but our money in the bank, for the bank statement will show an increase in our money, but our cash book will not show this. Our cash book will not show that. And this could also be things like what? Dividends. We have shares. We have shares from Safaricom. We have shares in Safaricom, and therefore, we are receiving dividends at the end of the year. We're receiving dividends at the end of the what? We could also talk about errors by the bank. Errors and fraud. Errors and what?
Right.
Fraud by the bank. By the bank employees. Yes, errors and fraud by the bank employees. Now, we gave them 1 million shillings, but they recorded 100,000. They recorded 100 what? Thousands. So, basically, you realize that they will not agree, because our cash book we recorded 1 million shillings, and the bank statement is recording 100,000. They have taken our 900,000 shillings. It is causing the difference. It is causing the difference, and therefore the purpose of the bank reconciliation statement is, number one, to update the cash book. Is to update the what? What are we saying by updating the cash book? We are saying anything that we have received, anything that we have recorded wrongly, we need to correct that error. Anything we have recorded wrongly, we need to correct that what? Error. For instance, if we recorded, we have received 1 million shillings, well, actually we have not received 1 million, we received 100,000. We overstated the debit. We overstated the debit with how much? With 900,000. We debited with 1 million instead of debiting with 100,000. So we overstated with 900,000. So we need to go to the cash book and credit it, and we call it cash book overstatement. Cash book overstatement. And we credit it with 900, we reduce it with 900,000, so that the net effect will be 100,000. The net effect will be 100,000. The net effect will be 100 what? 100,000. Now, please mark this. Mark this. Mark this. There are things we have collectively done, but the bank has not done them. There are things we have collectively done, but the bank has not done them. Those things are not corrected in the cash book. For instance, we recorded we have received the money, and on 30th of June, even 30th of June, we recorded we have received 2 million from William Luto. We recorded we have received how much? 2 million from William Luto on 30th of June, but the bank has not recorded it. The bank has not recorded it. Now we call that a reconciling item because it's not an error. It's not an error. It is something that was correctly done, but it has not been done by the two parties. It is not an error. It is a reconciling what? Item. Or we made payments. We made payment to William Ruto. We made payment to who? William Ruto, amounting to 750,000, but we made it on 30th of June 25. We made it on the 30th of June 2025, and we made it via a check. We made it via what?
Check.
Via a check. Now, basically we are saying that it's not a mistake, but we recorded it, but the bank has not recorded it. It's not a mistake. The bank will record it the following day. The bank will record it the following day. Whatever we did, and the bank has not done, and it is not a mistake, it becomes a reconciling item. It becomes a what? A reconciling item. It becomes a reconciling item. It becomes a reconciling item. Now, the same thing with the bank statement. The same thing with the bank statement. There are things the bank statement has done and they are correct. There are things it has done, the bank has done, and they are what? They are correct. And for instance, when they pay bank charges, or even they pay our standing orders, they could even some things called what? Standing orders. Standing orders. This is why we tell the bank every month by a faith ensure that you pay rent for our building amounting to 300,000. Now, the bank will pay, but until we get a bank statement and you confirm that the bank has paid, we will not capture it in our cash book. So whatever the bank has done, and it is not a mistake, it has been correctly done, but we have not done, now we do it in our cash book. We do it in our what?
Cash book.
We do it in our cash book. For instance, there are bank charges. We add all the bank charges. We add that, we subtract, we credit, we show it, we have spent that money, we credit our cash book. We may be having direct deposits. People deposited money into our account and we didn't know, and therefore now we need now to come to our cash book and we debit our cash book. And you are saying Peter Mwariama has given us 1 million shillings. Yeah, you capture it in the cash book. It could even be additional check. Somebody gave us a check and the bank did not honor it, and therefore because we had shown money we have received, now we reduce the check. Please mark this. When a check is, mark this, when we receive money from a customer, we debit bank and we credit the customer's account. We debit bank and we credit the customer's account to record a collection, a reduction in the asset of debtors. A reduction in the asset of what? Debtors. So our cash increases, but our debtors reduce. Now, when that is reversed, we also reverse the transaction. We reduce the cash which we are said to have received, so we credit cash book. You credit cash. You credit cash. You credit cash. That is not even actually cash. You credit bank. Remember, it's the bank column of the cash book. You will come because we had added money by debiting. To reverse the debit, we credit bank as we debit trade debtors. As we debit trade what?
Debtors.
Trade debtors. By debiting trade debtors, you are reinstating what you had removed by crediting it. You are reinstating what you had removed by crediting it. Now that we have learned about how to have the items that are causing the difference between the bank statement and the cash book, we now prepare the bank reconciliation statement. We prepare the bank reconciliation statement. And I want to explain the steps you take. I want to explain the steps taken to prepare a bank reconciliation statement. A bank reconciliation statements. The first step is update the cash book. The first step is what?
Update the cash book.
Update the cash book. Update the cash book. What are we saying? What are we saying? We are saying there are things that are in the bank statement that we have not captured in the cash book. They are correctly done, and we have explained them. Things in the cash book that are correctly done, but we have not captured in the cash book. Something like bank charges, payment of standing orders, receipt of money for on our behalf as interest income, dividend income, or even direct deposit by our customers. We now go to the cash book and we record them. If it is bank charges, we debit, we credit. If it's our bank charges, we credit a bank account in the cash book. If we have the bank account in the cash book, the bank account in the cash book, we have the debit and credit. So if it's a payment, if they have paid rent on our behalf, we will come to here and say they have paid rent 500,000. If they have paid bank charges, they have paid themselves bank charges, we will come and we will say bank charges. We will pay bank charges. We say bank charges maybe 20,000. Remember, the bank statement, you will always be given the balance in the question. You will be given the balance in the question. So you're adjusting the bank statement. You're updating the cash book. You're updating the cash book. If there are any expenses which have been collected, paid on our behalf by the bank, and we have not captured in our cash book, we now capture. If they have received dividend income, dividend, we debit. If they had received interest income, we debit. We debit, record an increase in the money in the bank. If we have some direct debit, we debit it, we record it. If we have done errors, if there are some things we are recorded, we will come and debit and we say errors. We come and debit and we say errors. If there is something we have over-reduced our bank account in the cash book, we will come now, we had overstated. If we have overstated the banking, we will come here and we say error to reduce the overstatement. Now, at the end, after doing all the adjustments, we will have something called balance carried down. And this is the balance that this is a correct balance that will be used in our balance sheet. That's the correct balance to be used in the balance sheet as our bank balance. Now, something very, very, very important. When you are being told about the opening balance, you'll be told whether it is debit or credit balance. If it is debit, it's on the debit side. It's money we have in the bank, balance brought down. If it is credit, you will put it on the credit side. Many students are told about the balance, and you told it was a credit balance, and you come and you bring it on the debit side. It's supposed to be on the credit side. You need to be careful about that. So you update your cash book that way. Number two, compare the debit side. Compare the debit side of the cash book with the credit side of bank statement. Through ticking. We want to ask ourselves, at this point we are asking ourselves, if everything that we debited, was it credited by the bank? Everything we debited, was it credited by the bank? Now, if it was not credited, by debiting, we are saying we received the money. Now, anything that we are recording we received, but has not been credited, most probably is either an error or an unpresented checks. Uncredited deposits. It's either an error all an uncredited deposit. And therefore, you now have to deal with those two things as reconciling items. As reconciling items. Don't forget, if it's an error by ourselves, we correct the error. We correct the error. If it is an error by the bank, you cannot tell them to collect at that point in time. You have to record it as a reconciling item, and then you follow the following day or the following week. So you compare that. So whatever is, if we have, this is our bank statement, and if we say this is the cash book, and the times this is done, and the only thing you have in the question, it is a very big document called the bank statement and the cash book, and all you're supposed to go is to tick the corresponding entry. So we debit and credit. So we are basically saying you will look at the cash book from the first day to the last day. You look at the cash book from the first day to the last day. So you look at the debit side of the cash book. Now, not this cash book, but the earlier cash book. The earlier cash book. Remember, this one we have only adjusted. We have been transacting very many things in the course of the week. So you compare the debit with the credit. You compare the debit with the credit. You compare the debit with the credit. You compare the debit with the what?
Credit.
With the credit. I want to show you exactly what you do. Assume that this is now the old cash book. The old cash book. The old cash book. This is the cash book. This is the what?
Cash book.
This is the cash book. And we say we only concentrate on the bank column. You concentrate on what?
The bank
column. And therefore, we are saying we compare the debits. So we compare the debits with what? Credit. We compare the debits with credit. So our debits could have been, these are money, the debit side is money in. So you could find you have 50 shillings, 1,000, 100,000, 200,000, 10,000, 200, 5,000, 20,000, 10,000. So we are comparing our debits with our credits. So you may come here and you find our credits are 50, 1,000. They are actually supposed to be the same. 100,000, but you might find this is 2 million. 2 million. 2 million. Let's do it to 100,000. 100,000. Let it be 200,000. And then let this one be 10,000. Let this one be 5,000. Let this one be 200. Let this one not be there. Let this one not be there. Let this one be there. 10,000. And let this one not be there. So what do you do? You get the cash book and you get the bank statement. Whatever is here and is here, you tick. You come here and say 50, 50. 1,000, 1,000. 100,000, 100,000, 100. Definitely there are more descriptions here to confirm that it is exactly the same. 200,000 here, 200,000. 10,000, but you can see here, the cash book shows we collected 10,000, but instead of taking 10,000 to the bank, we only took how much?
5,000.
5,000. And therefore, there is a question there. That is a question. So the question is, did the cashier consume this money, or is it the bank which made an error? Instead of capturing 10,000, they captured 5,000. So you investigate. Then 200, you tick 200 and 200. Then 5,000. You can see this is 5,000, but it is not anywhere in the bank statement. Where did the money go? Then 20,000. It is not here. Where we collected 20,000. We are saying we took the money to the bank, but when you go to the bank statement, it is not there. Is it an error by the bank, or is it fraud by our firm? We have 10,000 and we have 10,000. And therefore you tick and tick. So whatever we are not ticking both sides, it is telling you those are areas of investigation. Now, you find the last one is 100,000 and it is not here. So this is what we are saying. This might be uncredited deposit. It might be uncredited what?
Deposit.
They are monies that we collected the last day, we took to the bank, but the bank did not update that money that day. They updated the day after. So once you do this, the outstanding issues are investigated. If it is an error that we made, we collect our error. If it's an error by the bank, you can't force the bank to correct the error. It becomes a reconciling item. If it's an uncredited deposit, it becomes a reconciling item in the bank statement. Number three, compare the credit side of the cash book with the debit side. You do the same. The debit side of the what? Of the bank statement. The debit side of the bank statement. The debit side of the bank what? Statement. Now you come again, when you are making payment, we are saying to Peter Mogoroki, we are saying to Justus Kagodo, we are paying to PK, we are paying to JN, we are paying to KQ, we are paying to Ruto, we are paying to Kalonzo, we are paying to Wamalwa, we are paying to who else? Bigadi. So we are paying to so many people. So to PM we paid 20,000, to JK we paid 100,000, to PK we paid 200,000, to JM we paid 50,000, to KQ we paid 90,000, to Ruto we paid 100,000, to Kalonzo we paid 50,000, to Amara we paid 10,000, to Bigadi we paid 20,000. Now, when we pay in the cash book is a credit, but in the bank, this is not cash book, this is bank. This is bank. In the bank, it is debit because the bank is reducing the liability. Reduction in liability, we debit the liability account. So you come here and the bank will now say PM and will give you the check account, the check number this, and it will give you 20,000. It will give you 20,000. It will give you this one. It doesn't. You have to follow. Maybe PK took it early, took his check earlier, 200,000. Then JK took his check 100,000. JN took the check 50,000. But the others have not taken their checks. The others have not taken their what? So when you come, we now compare. PM 20, so you tick PM and you pick. You pick PK 200 and you pick PK 200. You pick JK 100 and JK 100. You pick JN 50 and JN 50. The remaining 190, 240, 260, 270, 280, the remaining 280,000 checks we paid as a firm, but the customers never presented to the bank. These are unpresented checks. These are unpresented checks, and they become reconciling items. They become what? Reconciling items. And after those three steps now, you prepare the bank reconciliation statement. You prepare what? The bank reconciliation statement. Please mark the order. Update the cash book. Go to the debit side of the cash book, compare with the credit side. Go to the credit side of the cash book, compare with the debit side. And the differences are reconciling items. You either update the cash book or remain reconciling items. It is worth noting. Ordinarily, reconciling items are usually three types. Reconciling items are usually how many types?
Three.
Three only. Number one, uncredited deposits, unpresented checks, and errors by the bank. Errors by what?
By the bank.
Errors or fraud. Errors or fraud by the bank. Those are the reconciling items. Otherwise, anything that is in the cash book that is Anything in the bank statement that is not in cash book, we update. We update the cash book to get the correct balance to be taken to the balance sheet. We update the cash book to get the correct balance to be taken where? To the balance sheet. To the balance sheet. To the balance sheet. Now, how then? Now do we prepare the bank reconciliation statement? Now that whatever was not recorded in the cash book we have recorded, the items causing differences have been minimized. They have been minimized, and they are very, very few. Therefore, we prepare the bank reconciliation what? We prepare the bank reconciliation what? Statement. We prepare the bank reconciliation statement. We prepare the bank reconciliation statement. So we say, Peter Kagodo Enterprises, Peter Kagodo, the name of the firm, Enterprises, bank reconciliation statement. As at 30th of June 2025. So this is a format. This is a what? This is a format. Please mark that is a format. And then we say there are two formats. So I call this one format 1. Format 1. So we say balance per updated cash book. Balance per updated cash book. Balance per updated. Please note that it is not the balance you got in the question. It's not the cash book balance you got in the question. It is the balance you get after adjusting the cash book balance. It is the updated cash book. It's the updated cash book. And then we ask ourselves something. We ask ourselves something from here. We ask ourselves something. We ask ourselves what? Something. If what we have done and the bank has not done is reversed, would we get the same balance? If what we have collected done and the bank has not done is reversed, would we get the same balance? Will you get the same balance? Will we get the same balance? For instance, if we made payments, and we reduced our money. So if we add what we paid, which the bank has not deducted, if we added back, if we add unpresented back checks, if we add what we have paid, add unpresented checks, if we add our unpresented checks, yes, if we add what are we doing? We are asking ourselves if what we have done and the bank has not done is reversed, would we end up having the same balance as the bank? Would we end up having the same balance as so we add back. We are acting as though we are reversing. Whatever we subtracted, we add back. Whatever we added, we subtract. We are acting like we are reversing what we have done, and we are also acting like the mistakes that was done by the bank, we also made the same mistake. We are also acting as though the mistakes made by the bank, we made the same what? So if the bank added to us, add error by the bank. We want to know if those are the only causes of the difference. If so where the bank added our money and we have not added, if we did everything, because the bank added, if we add, would we come to the same balance? So we then say less. Now we added money which was not credited. Whatever we uncredited deposit, we subtract. Uncredited deposits, we subtract. Now less errors by the bank. If the bank removed our money, our money, errors by bank, this is a reduction. If the bank reduced our money, we check, we deduct. whatever the bank did to our money which was wrong, we act as though we have done it, so that we're asking ourselves, if what they did to our money, we do it, will we get the same results? Basically, we're asking ourselves, are these the only causes of what? Of the difference? Are they the only causes of the difference? Are they the only causes of the difference? And we will find ourselves getting balance per the bank statement. Balance per the bank statement. Balance by the bank statement. But this is going to prepare the bank statement using format 1. We are starting with the cash book. We are starting with the what?
Cash book.
We are starting with the cash book. We're basically saying, this is our cash book balance. This is our cash book what? Balance. The reason our cash book balance, at this point, the reason our cash book balance is not agreeing can only be 2. Can only be what?
2. Can
only be things that we have done correctly and the bank has not done. We have paid money, drew and presented checks, or we have recorded money, we have received bank deposits, and the bank has not credited our accounts. Or it could also be caused by errors by the what? By the bank. And therefore, we do as though we are doing what the bank has done. If the bank has increased our money, we also increase our money. If the bank has reduced our money, we also reduce our what? Reduce our money. So that we can find out if those are if we reversed those things, if we reversed the errors and we reversed the payments, would we arrive at the same balance as the bank statement? And that should be the case. If that does not happen, then it means there is a problem we do not know that is causing the difference between the cash book balance and the bank statement. And therefore, we investigate further. We investigate further. Now, the next format number 2, we start from the bank statement. Format number 2, we start from the what?
Bank statement.
From the bank statement. Now, please note that format number 2 is assuming if what we did, we did not do. If we reverse what we have done and we have not, and the bank has not done. If we reverse what we have done and the bank has not done, that's the first question. Will we get at the same balance at the bank? So we say balance as per what? As per the bank statement. Now, the first one, we were reversing. We were asking ourselves, if we reverse what we as the firm have done, would we get the same balance as the bank? In this case, we are asking ourselves, if the bank did what we have done, would we get, if we subtract from the bank statement, we subtract what we have subtracted in the cash book, but the bank has not subtracted, and we add what we have added in the cash book and the bank has not added, would we arrive at the same balance as the bank's balance? So we are saying balance as per the bank statement, you add what we have not added, you add uncredited deposit, you add uncredited what?
Deposit.
You add uncredited deposit. So we are asking if the bank did what we have done, would we have the same balance? And then we also add bank errors. If you add errors by the bank. Now, if the bank for whatever reason reduced our money, let us reduce. And then we less unpresented checks. Uncredited deposits. We add. Yes, we less unpresented checks. We are changing the bank balance with whatever we have done. And we also less error by the bank. Whatever we have added, we subtract. And therefore, we should be able to get balance per adjusted cash book. Balance per adjusted what?
Cash book.
Cash book. Balance per adjusted cash book. We are asking ourselves in format number 2. We are asking ourselves in format number 2. If we do what was done in the farm, if the bank had done what was done in the farm, would we get the same balance as our balance? Would we get the same balance as our what? So if we have deducted, let the bank deduct. So the bank is deducting and presented what? Checks. The bank is deducting and presented checks. If we added, like the uncredited deposits, we are also adding. We are adding uncredited what? Deposit. We are adding the uncredited deposits. We are adding uncredited what? Deposit. Now there are monies which the bank has given us, which has added to us. And therefore, we need to reduce. And whatever we have reduced, we need to add. Whatever they have reduced, we need to do what? To add. We are asking ourselves, after making those adjustments, are we having balance per adjusted cash book? Are we having balance per adjusted cash book? We are saying our cash book does not have errors. It is the bank which has errors. And therefore, where the bank added, we now subtract. Where the bank added, we now do what? Subtract. Where the bank added, we now subtract. Where the bank subtracted, we now do what? Where the bank reduced, we add. Where the bank did reduce, we do what? We add. Then we get our balance per adjusted cash book. That's the way to prepare the cash book, the bank reconciliation statement, format 1 and format 2. The first format says, if we reverse what we have done as the firm, if we reverse what has been done in the cash book by the firm, but correctly, at the bank reconciliation statement, will we get the same results as the bank? Number 2 says, if the bank did what we have done, if the bank did, where we credited, they credit. Where we debited, they debit. If they did that, would we have the same balance as the bank reconciliation statement? That's the way to prepare them. Please remember to subscribe, like, and share. Thank you very much.